All right, let's dive in. Today, we're peeling back the curtain on one of the most intense, high stakes journeys a company can ever take, the initial public offering, or IPO. This is the real story of how a private dream becomes a very, very public reality. It's a phrase we hear all the time, right? Especially when some hot new tech company or a brand you love decides to finally hit the stock market. But what does that actually mean? What's really going on behind the closed doors of those boardrooms and investment banks? Because here's the thing, an IPO isn't just about raising a boatload of cash. It's way deeper than that. It's a complete and total transformation. The company has to re-engineer its entire DNA, from its culture to its accounting, just to survive life in the public spotlight. So we're calling this whole process the IPO metamorphosis. And we're going to break it all down for you, right here, against the backdrop of what's happening in the 2024 and 2025 IPO market. After a really quiet couple of years, the floodgates are opening again, which makes this journey more relevant than ever. Okay, first thing you have to get your head around is that going public isn't a sprint. It's an absolute marathon. And it starts years, literally years, before the company ever rings that opening bell. I mean, just look at this roadmap. We're talking 2 full years out, and the company is already picking its lawyers and its auditors. At 18 months, they're completely overhauling how they track their own performance. A year out, they're literally rebuilding their board of directors. This is not a last-minute dash for cash. It's a slow, deliberate, and frankly, grueling buildup. And what are they building during all this time? Well, they're upgrading their whole operation to be public grade. That means their financials have to be squeaky clean, audited to a standard so high it has its own government oversight board. Their board needs outsiders, independent directors, to meet the stock exchange rules. And they have to install these super strict internal controls thanks to a law called Sarbanes-Oxley. Oh, and they also have to hire a whole new team just to handle all the new SEC paperwork and, talk to all their new investors. It is a complete internal renovation. So, once the company gets its own house in order, it's time to go out and face the world. They have to convince Wall Street and the US government that they're ready for prime time. And trust me, this is where the real drama begins. First up, you've got something called the bake-off. Seriously, imagine a corporate version of a reality TV cooking show. All the giant investment banks, Goldman Sachs, Morgan Stanley, you name it, come in and pitch the company. They show off their best financial models, their secret sauce for selling the stock, all competing for that one huge prize: to be the lead underwriter. This is the company's single most important partner in the whole process. But as soon as that bank is hired, they are immediately caught in this fundamental tug of war. See, they're serving two masters with opposite goals. The company that's paying them wants the absolute highest share price possible. But the bank's other clients, the giant investment funds who are going to buy the stock, well, they want the lowest price possible so they can get a big win on day one. Navigating that tension, that's the real art of the IPO. Next, the company has to basically write its autobiography. It's called the Form S-1. And don't let the name fool you, this is not some boring government form. This is the company's grand debut to the world. It lays out everything: the business model, the financials, and most importantly, a huge, brutally honest section on every single risk and every single thing that could possibly go wrong. This is their one shot to tell their story. And you better believe the world's toughest critics are reading every word. And who's the first to read that autobiography? The SEC. The Securities and Exchange Commission. The company submits the S-1, usually confidentially at first, and then the SEC's army of lawyers and accountants just tears it apart. They send back these things called comment letters, demanding more details, asking tough questions, and this back and forth can drag on for months. And during this entire time, the company is in a quiet period. They are legally forbidden from doing anything that might look like they're hyping up their own stock. Okay, so after all those months, sometimes years of prep work, we finally get to the climax of the whole journey. It's time to set the price and ring that opening bell. This is the moment where all that hard work either pays off or, well, doesn't. And that brings us to this number, 18.8%. What is that? That's the average first-day pop for an IPO in the US. It's the jump in the stock price from what the first big investors paid for it to where it closes at the end of its first day of trading. Now, a big pop sounds great, right? But in the industry, that 18.8% is also called money left on the table. It's cash the company could have had if they just priced the stock a little higher, which leads to the absolute billion-dollar question: why? Why on earth would a company go through all of this just to knowingly underprice its own stock and leave millions, sometimes billions of dollars on the table?
Well, there are some pretty fascinating theories out there. One is called the winner's curse, the idea that you have to give investors a discount to make sure they keep playing the game. Another is signaling theory, where a really good company leaves a good taste in everyone's mouth, signaling that they're a quality company for the long run. And of course, there's the simple idea that a massive first-day pop is basically free marketing that can be worth more than the cash they left behind.
And when that stock finally starts trading, how it happens is completely different depending on where it's listed. It's like two different worlds. At the New York Stock Exchange, it's this old-school, human-driven process. A specialist, the designated market maker, can spend hours manually balancing buy and sell orders to find the perfect opening price. Over at NASDAQ, it's all tech. A purely electronic algorithm called the IPO cross matches all the orders in a nanosecond, and the stock just starts trading. But listen, the story is far from over when that bell rings. In fact, that's just the beginning of a whole new chapter. The first few weeks and months for a new public stock can be incredibly wild, and there are some specific tools used to try and manage all that chaos. The most important tool has a really weird name, the green shoe option. It's named after the first company that ever used it, Green Shoe Manufacturing. Basically, it lets the underwriter sell an extra 15% of shares. Why? Well, if the stock price starts to fall after the IPO, the underwriter can then step into the market and use the proceeds from those extra shares to buy stock back, creating a floor and supporting the price. It's a crucial safety net. The other key mechanism is the lockup period. This is a simple but powerful idea. It's an agreement that stops all the insiders, the founders, the execs, the early investors, from selling any of their shares for a set period, usually 180 days. The goal is pretty obvious: to stop a tidal wave of stock from hitting the market all at once and crashing the price. That's why the day the lockup expires is always a huge, closely watched event for a new stock. Now, it's really important to know that this whole traditional, grueling process we've just walked through, it isn't the only game in town anymore. In recent years, a couple of other major paths to the public markets have become really popular. And this chart really lays out the modern menu. You've got the traditional IPO, which is all about raising fresh cash. Then you have SPAC mergers, which are much faster but can really dilute the ownership for the original founders. And finally, there's the direct listing, which is way cheaper because you're not raising new money, but it gives you zero certainty on what your stock price will be. Each one has a totally different set of pros and cons. So at the end of the day, what this all comes down to is that an IPO is so much more than just a way to make money. It's a trial by fire. It is a rigorous, painful test that forces a company to grow up, to build discipline, and to prove to the entire world that it's ready for the highest level of scrutiny imaginable. Which leaves every founder and every private company with one final, fundamental question. Is the prize, all that capital, the ability for employees to cash out, the public recognition, is it actually worth the price? Is it worth giving up your freedom, your privacy, and a huge amount of control to live permanently under a microscope? That is the billion-dollar trade-off at the very heart of every IPO.